Welcome back to Intelligent Investment Today, the podcast concerned about all things value investment. In each episode, we consider a different aspect of the teachings of Benjamin Graham, the investment style's founding father and author of the books The Intelligent Investor and Security Analysis. In this episode, we take a look at cryptocurrencies, something, of course, that was not around in Graham's day, and consider what he might have thought about it, and if the art of value investment can in any way be of use to the prospective acquirer. So as usual, make yourself comfortable and prepare yourself for another dose of intelligent investment today. Most people have heard of and understand the general concept of cryptocurrency, but it is worth, I think, just to take a moment to define it without getting too bogged down in detail. Crypto is a type of digital currency that is designed to work through a computer system without the reliance or oversight from any central authority, such as governments or banks. Ownership details of crypto coins are stored in a highly secure database that is designed to be virtually insurmountable to eavesdroppers, such as any agencies who may have interest in the ownership details of such currency. One potential attraction of cryptocurrencies, therefore, is of course that they offer a very high level of anonymity. This anonymity may be desirable for perfectly innocent reasons, but this also makes it an attractive proposition to those who wish to evade detection of their financial transactions, perhaps for more nefarious reasons. Whilst cryptocurrency is designed first and foremost as a means to make and receive payments, it has increasingly become an asset class all of its own in which people like to speculate, hoping that they can profit from changes in its value. Bitcoin was the first cryptocurrency on the scene back in 2009 and remains the most well-known of the currencies, but there are now tens of thousands of competing forms of cryptocurrency. The asset class has become well known for its volatility, but with many of these currencies performing well over the last few years, there are of course no shortage of individuals willing to take a punt. So what would Graham have thought of crypto, and is there anything at all in his teachings that could aid the crypto investor? The short answer to those questions are not much and no. While speculating what Graham might have thought of an asset class that did not exist in his day must clearly be supposition, I think there is enough evidence in his writings to confidently say that he would not have been a fan. The first thing to say is also perhaps the most obvious. Graham was a value investor. He sought out assets that were undervalued based on the facts of the matter. If a business was selling for much less than it should, based upon the profits generated and or the value of the assets owned by the business, then he would consider its purchase. Almost by definition, cryptocurrency cannot be overvalued or undervalued because there is no logical value that can be attached to it at all. The price at which it is trading is solely a function of how the general market is feeling at that moment in time. It has zero intrinsic value. Its worth is based solely on the greater fool school of investment. The idea there will always be someone more foolish available to pay an even higher price. The investor in cryptocurrency is therefore prone to act exactly like Graham's Mr. Market, with nothing other than hearsay to guide what cryptocurrencies are going to do this week, this month or this year. How can a holder of crypto possibly have the confidence in their decisions? And what weapons do they have in their armoury to prevent irrationality creeping into their thinking? Whilst cryptocurrencies were not around in Graham's day, there were other asset classes that had similar characteristics to crypto. Investments in gold would be one of them. Whilst gold is a very well-established asset into which wealth can be stored, when you actually think about it, it is not totally dissimilar to crypto. If you were ever to meet an alien and you tried to explain that we as humans expend massive energy and resources digging up this gold-coloured metal from the ground, only then to rebury most of it in underground bank vaults, they would probably think that we were crazy. Less than 10% of gold goes into doing useful things in the form of technological functions. Most of it will be squirreled away in vaults, never to be seen again. Even in the form of jewellery, it only has psychological value. A solid gold Rolex does not perform any better at telling the time than a $10 Casio. And nobody except the wearer knows whether a necklace is gold or a gold-coloured alloy. The value of gold, like cryptocurrency, is based to a very large degree on what people are prepared to pay for it. Buying gold, as with buying crypto, must essentially be based upon guesswork, that the mood music will alter after purchase and the price will rise. The expectation of rising prices is based on nothing other than the idea that the investor is in the belief that they can predict the future. It should come as no surprise, therefore, that Graham avoided investing in gold and questioned why people would hold on to an asset that produced zero income return and more often than not proved to be a poor hedge against inflation. We should all know that Benjamin Graham was keen to avoid anything that resembled crystal gazing. Graham believed in evidence-based investment decisions. In order to beat the fate of Mr. Market, the investor must be able to reasonably estimate the value of an asset based upon its financial display and not rely on market sentiment to turn a profit. So if Graham disliked gold as an investment, which at least brings pleasure to the wearer when it takes the form of jewellery and has some use in electronical applications, then it seems hugely improbable that he would have any time at all for crypto. For what does it do, in fact? As well as its limitations as an asset class, crypto also has its disadvantages purely based on its function as a currency. Sure, it has the benefits for those seeking anonymity, but its main advantage would only serve to hasten the regulation it wishes to circumvent. Governments rely upon the ability to eavesdrop on financial transactions. This allows them to collect the correct taxes and prevent criminal activities. Whilst cryptocurrencies are currently small enough in value for them to turn a blind eye, at some point they will seriously endanger the flow of tax revenues and aid the function of criminals and terrorists, and they will need to come down on them like a ton of bricks. To conclude, we can say that we can be pretty certain Graham would consider investment in cryptocurrency a form of de facto gambling. There is no logic or basis by which a valuation can be placed upon its price. The price solely being a function of the prevailing feelings of those who invest in it. If they are feeling chipper as a whole, then the price will be high. If they happen to be doom and gloom that particular day, it will be worth a lot less. Whilst gold is not bad, at least in the same way as crypto, Graham avoided investments in this for similar reasons to why I believe he would also shun cryptocurrencies. It doesn't provide an income, and it doesn't typically have any assets supporting it. So if you really must invest in crypto, then please consider Graham's advice about speculation in general. And that is never to confuse speculation with investment. If you must speculate, then mentally keep these actions separate from your investment portfolio. Concede that you are gambling and accept that you are likely to receive a gambler's return on your investment. And that is all for this episode. If you've enjoyed it, please do consider adding the show to playlist in order to be alerted whenever a new show drops on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.